Good morning, colleagues. Good morning, economics learners. I apologize that we are a bit late today. I am Nthabise Mofokeng. I'm going to take you through today's presentation. And our presentation today, Suhunelo, thank you. Right. So today we are going to look at the foreign exchange markets. We are going to look at the foreign exchange markets. And one may wonder, why are we doing foreign exchange markets now when we are busy with the microeconomics? If you have been following the presentations, we have done all the 3 topics of microeconomics. So we are now today preparing you for the June exam. So we decided to take you back to foreign exchange markets, which is a topic that you did in term 1. And it was the last topic of the term. So we feel like it's necessary that we do it now again so that we are preparing you for paper 1, which will be written on the 18th of June. Now, before we can go any further with our presentation, I want you to take you to the examination guidelines. You know, learners, that this is the Bible in economics. There's nothing that you can do without looking at your examination guidelines. So as you are studying, it is important that your point of departure is for you to know what is examinable in every topic that you are going to study. Now, with the examination guideline, this is what is expected. You are expected to examine the foreign exchange market and the establishment of the exchange rate and show how the balance of payments account is affected. So we are going to go through all these topics today. The first one will be the reasons for international trade. So in terms of the reasons for international trade, it is important for you to know that in our examination guideline, when you see discuss in detail, you know that this is an essay. So when you see discuss in detail, you know that this part of the content is regarded as an essay. So in this chapter, the essay that we have is the reasons for international trade. Now, what is expected from you in terms of the reasons for international trade is for you to discuss in details the reasons for international trade, and we have the demand reasons as well as the supply reasons. So under the demand reasons, we are going to look at the size of the population, income levels, change in wealth of the population, preferences and tastes, differences in consumption patterns. I want to emphasize this, learners. I know you are using so many resources, but the examination guideline is your main resource. So when we expect you to write an essay, the subtopics that we only want from you are these ones that appear on the examination guideline. So if you are using any other material that has headings for demand reasons which are not on our examination guideline, they will not be accepted. The same goes with the supply reasons. The supply reasons that we are going to look at are natural resources, climatic conditions, labor resources, technological resources, specialization, and capital. No other heading under the supply reasons except for this one that I mentioned on your examination guideline. Now let's look at the second topic. There is a bit of misalignment there. Still under the reasons for international trade, there is also a question that you can expect, that where you are expected to briefly discuss the effects of international trade. Now this question, you can expect it as an 8-mark question where you will maybe be expected to discuss any 2 of those effects of international trade. Now we go to the balance of payments. What is expected from you when you study the balance of payments? It is important for you to know the concepts. All the concepts that are related to the balance of payments, you must also be able to explain the value or the purpose of the balance of payments. This one, you can expect it for 2 marks. where you, for instance, if it is in question 2, it will appear under 2.1.2, where you are expected to explain the value of the balance of payments or the purpose. Or you can expect that kind of question in a data response form in your data response questions. Now, the composition of the current account. Like I said, I know you use a lot of material. In the past, our balance of payments had 4 accounts, but the new balance of payments only has 3 accounts. So whenever you are studying, just make sure that you always go back to your exam guideline and look at what is actually expected. Now we are going to discuss the composition of the current account. And this is how the current account looks like. We'll do that as we go on with our presentation. Then we have the capital transfers account and the financial account. Now in these 3 accounts, it is important for you not to only know what the components of each account are, but also to know what each component actually means, right? So we go to the next topic, that is the correction of the balance of payments, surplus or deficit, and we call it disequilibria. Now, in terms of the corrections, we are going to look at the discussions of different measures that can be used to correct a disequilibria in the balance of payments. And like I said, and I'm going to emphasize this as we go, these points that you see here, these headings are the only ones that you are expected to learn in terms of correcting the balance of payments. You are expected to study the interest rates, import control, borrowing and lending, change in demand, export promotion, import substitution, and changes in exchange rates. So in other words, if the material that you are using has more than these listed measures, you only focus on these measures. And if your books do not have some of these measures, please ask your teacher to give you supplementary material that will give you all these corrective measures as they appear here. Right. Now we go to the foreign exchange markets. Now, what is expected from you in terms of the foreign exchange market? Most importantly, description of concepts. Now, under this foreign exchange markets, we have the description of what exchange rates are, appreciation of the currency, depreciation of the currency, devaluation, revaluation, foreign exchange control. And then under this topic of foreign exchange markets, we are going to look at the factors that affect demand for a currency, the factors that also affect supply for a currency. We are going to look at the graphs, how the currency is established, how do we reach an equilibrium, and what happens when the currency changes, when it appreciates or depreciates. Then we are going to look at those graphs. So when you study this topic, it is very important. You see, it says exchange rate equilibrium, draw and interpret graphs. For you to only know a graph in the form of a data response, it is not enough. You need to know the graph, but you also have to be able to draw your own graph and interpret it. The same goes with the changes to equilibrium. Then we look at the establishment of the foreign exchange rates. Then under this establishment of the foreign exchange rates, we expect you to know how to briefly explain the following exchange rate system: the free floating, which is used in our country, and the managed floating, which is regarded as the fixed exchange rate. The managed floating and the fixed exchange rates. So those are our exchange rates that we are going to look at. And then the brief description of the terms of trade. Then, and the terms of trade, you need to know how to describe it. You need to know how the formula that is used to calculate the terms of trade, as well as the effects of the terms of trade in the economy. Now, this is your examination guideline. We are going now to go to our content that we are going to discuss today. Right. Now, our point of departure, every time when we study any topic, we look at the concepts. And I want to emphasize this in terms of concepts. Many times when you study learners, you go straight to the content without first understanding what this chapter of international trade, what is international trade? Before you can know the reasons that cause international trade, it is important for you to know what international trade is. And in the question paper that you are going to write, about 45 marks of the 150 in every paper are based on the description of concepts. So you need to learn your concepts and know that when we describe concepts, we have things that we call the elements of the description. Now, in terms of international trade, we say international trade is exchange of goods and services. Exchange of goods, services, and capital. Where are we exchanging these goods and services? Across the international borders or between countries. So, which means when we talk about international trade, you'll remember when we did the circular flow, we spoke about the open economy, which is an economy that involves the outside countries, the economy that involves us trading with other countries. So whenever we are trading with other countries involving the foreign sector in our trade, then we have international trade. Now, international trade is important because it allows countries to expand their markets, meaning that as South Africa, if we are involved in international trade, we are not only selling domestically, we are selling also to other countries. So when we do that, it means we have expanded our market. Our market becomes bigger. On the other hand, it happens that some of the goods that we need are not available in our country. So it helps us to access goods and services that we may not have domestically. Now, when we look at international trade, why is it necessary to have international trade? Because we have consumers who want to buy goods from other countries. We have producers who want to sell their goods to other countries. So for these two reasons, then we need to have international trade. So with international trade, we are going to look at the demand reasons that cause international trade, as well as the supply reasons that cause international trade. Now, let us start with the demand reasons. We look at the size of the population. What about the size of the population? How does this size of the population result into international trade? We say when a country has a large population, what is going to happen? It often cannot produce enough goods and services. So it must import these goods. Where are they importing them from? From other countries. So because of the large population, it means more people are there in the country. And when more people are there in the country, the demand for goods and services will be more. And when that demand increases, then the country may not necessarily be able to produce all the goods and services that this large population needs. So then, when that happens, we need to import certain goods from other countries. On the other hand, when a country has a small population, now it means the local producers may not sell all their products at home. We are going to have surplus goods. What are we going to do with these surplus goods? We are going to export them to bigger markets. Bigger markets can be in other countries. Remember, we said one of the reasons why we need international trade is to expand our markets. So when producers happen to have produced more goods and our population is so small, the demand is less than what has been supplied. So we have surplus goods. So these surplus goods, then we export them to other countries. And remember, whenever we talk about exports and imports, we are saying the trade is happening between two countries. Now we go to the next one, the levels of the income levels. Now what happens to the income levels? When people earn higher incomes, when they are now having more money available, they demand a wide variety of goods. So when they demand this variety of goods, some of these goods may not be available in the country. What do they do then? They export them from other countries. In that way, our exports increases. Remember, I said, whenever we talk about imports and exports, we are talking about the trade that is happening between two or more countries. Now, on the other hand, when the incomes are low, people don't have enough money. What do? When your money is less, you want to buy goods that are cheaper because you don't have a lot of money. So sometimes these cheaper goods, they come from other countries. So we see people importing, I don't even want to mention names of or sites where a lot of people are buying now, but you know that there are sites, international sites where we can buy goods. We import them from other countries at a cheaper price. Now, the changes in wealth. Change in income and change in wealth are not the same. Now, when the wealth of the population increases, now we are talking about wealth, not income. People start demanding luxury or high quality goods because they are wealthy. I guess they are now rich. They want designer clothes. They want furniture from other countries. They want to buy cars, German cars, and all those things. That is because now they have become more wealthier. Now, what do? When their wealth increases, they start demanding luxury or high quality goods. And this luxury or high quality goods may not necessarily be available in the country. So they have to import them from other countries. The same goes when the wealth decreases. International trade is still needed because people tend to cheaper foreign products. So when people have money, they buy from other countries. They want luxury items from other countries. But also, when their wealth decreases, they want to buy cheaper products. And some of these cheaper products can only be bought in other countries. Now we look at the preferences and tastes. People prefer certain brands. They prefer certain type of technology. Now, people often develop preferences for foreign brands, and this makes importing necessary because they prefer foreign brands. These foreign brands can only be bought in foreign countries. So because of these preferences and taste, then people find themselves having to import goods and services from other countries. Tastes also change internationally. And when that happens, countries with popular products, they export more to meet the global demand. This is because of the changes in the preferences and tastes. Now, changes in the consumption patterns. Different countries, we say they have different cultural habits and different lifestyles. Now, because of that, this creates the demand for goods that may not necessarily be available in this country, then what will happen now? They have to import them from other countries. This import is caused by the changes in their consumption patterns. International trade allows nations to access products that match their unique consumption patterns. Okay, there's a question. Kalabucha, you are free to ask. Kalabucha, you are free to ask.
You're too fast, man.
Oh, I'm sorry. Okay, I will slow down. Thank you for that. Let me slow down already on this very slide. Okay, let's start with the preferences and tastes. Because we say, because of preferences and taste, what happens? People want foreign brands. They want brands that are not available in our country. So where do they get these foreign brands? Because the brands are not available in our country, they have to import them from other countries. Now, also this happens because of the changes in their tastes, because internationally the tastes change. People no longer, fashion changes, and so are the taste of people. So sometimes you find that because of these changes, there is more, the countries that have products that are more demanded because of the change in taste, then they have to export more to those countries that do not have these popular products. I'm going to repeat. Because of the changes in taste, people change the things they liked. Now, the new products that are in demand, that are now becoming fashionable, some countries may not have. Now, those countries that have these popular products, these products that are now fashionable, they export them to countries where the demand for these popular products is increasing. Now, the differences in the consumption patterns. People consume goods, the consumption patterns of people change from time to time because of habits, because of lifestyles. Now, what happens? When these preferences change, there's going to be a change in demand for goods and services. And this demand for goods, these goods and services that are now demanded may not necessarily be produced in our country. So when they are not, everything that is not available in our country, it means now people are forced to import from other countries. And whenever they import, then international trade happens. Now, international trade allows nations to access products that match their unique consumption patterns. Because these products that match their consumption patterns may also not be available in our country. What will happen? They will now import them from other countries. Now, that is why international trade is important. It is important for people to meet their different consumption patterns, for them to access the goods that they do not have in their country, then they are able to access them from other countries. I hope I'm slower now and more audible. Now we move to the supply reasons. Remember what I said? I said the demand reasons they emanate mainly from the consumers. The supply reasons are more relevant to the producer. So because of the producers who want to sell their goods or who want to buy their inputs from other countries, then we need international trade. Because of consumers that want to buy goods from other countries, then we have international trade. Hence, we classify these reasons according to the supply reasons and the demand reasons. And I want to emphasize this. This question is an essay type question. And when you are expected to discuss the international reasons for international trade, you need, I know sometimes learners, you have a tendency of saying, these reasons are so many. I'm only going to focus on the demand reasons and I might get 26 out of that. Yes, it is possible, but it's more safer for you to know both the demand and supply reasons, because if you only spot the demand reasons or the supply reasons alone, it does not necessarily mean all your explanation, all the explanations that you have given are correct. So if you limit yourself, the chances of you getting full marks in the additional part of the essay becomes slimmer. Now let's go to the supply reasons. The first supply reason that we are looking at is the natural resources. Now we say these natural resources are not evenly spread across countries. What do we mean? We mean certain countries have natural resources that other countries do not have. For example, in terms of minerals, we have gold as our main mineral in the country, but we do not have oil. So what should happen then? It means we are going to sell gold and import oil from other countries. So that is why we say natural resources, because they are unevenly spread across the countries, no nation can trade and get, because they are not evenly spread, then it means nations do not have all the resources that they need. When they do not have certain resources, then they have to buy them from other countries. Now we say countries that have surplus of certain resources. What do you do when we have surplus in your country? You sell to other countries. So because of this, the fact that they are unevenly spread, countries do not have the same natural resources, then it forces them to buy the resources that they do not have and sell those that they have surplus resources. They sell this surplus to other countries. Now, in terms of the climatic conditions, different countries experience different climatic conditions. Now, when these climatic conditions are not the same, it means the crops that are growing in different countries will also not be the same. For example, in our country, we can't plant the coffee beans because of our climatic conditions, but we have a huge supply of grapes in Cape Town. Cape Town is our main hub of grapes. Then what does that mean? It means that is why South Africa is one of the biggest exporters of wine. But we do not have coffee because our climatic conditions do not allow us to plant the coffee beans. So when this happens, there's no way that we can be able to have coffee domestically. And certain countries, their weather conditions, they do not allow them to have tropical fruits. In Lesotho, they can't grow bananas. The climatic conditions there do not allow them to have bananas and pineapples, for example. So it means all these tropical fruits that they have been exported from us or from other countries. So now, because of these climatic conditions, we say countries import goods that their climate does not support, and they export those goods that are suitable to their own climate. So we take those that we are able to produce because of our climatic conditions, we export them to other countries. On the other hand, we also import those that we are able to produce and other countries cannot produce. Now we look at the labor resources. The labor resources is about the the human resource, the skills and qualifications that we have as a country and those that other countries also have. Now we say in terms of the labor resources, countries with many workers, those that have many workers or those that have low labor costs can produce labor-intensive goods more cheaply, which encourage them to export. Now it becomes an advantage for them. A question? Ikaelelo? You are free to ask. Ikaelelo, is your hand up? Ikaelelo, it's your opportunity. We are giving you an opportunity to ask your question. Okay, while you are still thinking, let's go on. Drop your hand and raise it again if the same question that you had, you still do. Now, in terms of labor resources, we say we have countries that have many workers, and we have those that have low labor costs. Remember, for production costs determine the price of goods that will be charged for the final goods. It also contributes towards the amount of production that will happen. If your labor costs are less, it means you are able to produce more. So what happens is when a country has low labor costs, they are able to produce labor-intensive goods more cheaply. Then because they are able to produce more cheaply, they are able to produce a lot, and they are also now able to export those goods and services. On the other hand, we look at the skill of workers. There are skills that we may lack as a country. If we have, for example, insufficient supply of technicians, what do? Are we going to say now we will abandon all the duties of the technicians as a country? That is not what happens. What will happen is we are going to import the skills from other countries. So because of the skills, the high skills in other countries that we do not have, then we are forced to import them from other countries. To move now. Those were our reasons for international trade. Remember, I said the reasons for international trade is a question that you can expect in the essay main part. Now we look at the effects of international trade. When we talk about the effects, we talk about the consequences. Now, because of international trade, countries are able to specialize. Remember, we said with international trade, we can have certain goods and other countries have other goods that we do not have. So the best thing is for us to specialize, which means now we are focusing only on producing the goods that we can best produce. Where we are able to have lower production costs, then we produce more of that. Where we have better climatic conditions, then we focus on producing those. Now, what does specialization do? It helps countries to use their resources more efficiently. You know, in economics, we are always concerned about efficiency, the use of resources in a way that there is no wastage. Now, if a country specializes, then they are able to use their resources more efficiently. They are not wasting resources. And when they are not wasting resources, it means they are able to improve the quality of their products. When they are involved with international trade, they specialize on goods that they are able to produce efficiently and they are able to improve the quality of their products due to efficiency. Now, specialization, on the other hand, remember with the effects, we can have either the positive or the negative effects. Now, in terms of specialization, the bad thing is that we become interdependent, meaning we depend on other countries. Now, what is bad about interdependence is that whatever happens in that country affects what happens in your country. For example, now we are experiencing a rise in the petrol price because we depend on other countries to supply us with petrol, with crude oil. So if they have war in their country, we are not able to access as much crude oil because of that, the circumstances that are in their country. We become affected. That is why we say specialization can lead to interdependence. And with interdependence, it means as a country, we become affected by activities that happen in other countries. We depend on them to give us crude oil. So if they have challenges that side, we are also suffering on this other side, and that we call imported inflation. Then because of international trade, countries are able to produce in mass quantities. We are able to experience mass production. Remember, we said we are able to use our resources effectively. And when we use our resources effectively, we are able to produce more output with the little input that we have. Now, because countries trade in global markets, they produce goods on a much larger scale, which can reduce their production costs. When you see production in large scale, you already know we are talking about mass production. So when we produce in large scale, we are able to reduce our production costs. So we cannot produce in large scale unless we have a bigger market. And we are able to expand our markets if we are involved in international trade. Remember, I said that. Now, we say again, mass production lowers the cost per unit, making goods to become cheaper because of low cost per unit, which means the average costs are less. If the average costs are less, then we charge lesser prices. So consumers get to benefit if there is mass production. And if our goods are cheaper, it means the demand for our goods will increase and we will be able to export more goods to other countries. Good. Now we look at in the efficiency. When you see the word efficiency, the first thing that you need to think of is using the resources without wasting them. Now, because of international trade, we become more efficient. We become less wasteful of our resources. Because we say trade pushes businesses to improve their skills, become more productive. And then they also improve the technology they use so that they're able to produce quicker. And they processes so that they stay competitive. Remember, when we are involved in international trade, we need to be competitive. We need to have products that are of a good quality, and we need to be more productive so that we are able to compete with other countries that are producing the same goods. So if we have better skills and we have better technology, we become more productive. We are able to use the little inputs and get more output on our production. And because we are efficient, we are not wasting resources, then our production cost also becomes lower. These are the effects of international trade. Now, this type of question, you can expect it as a 8-mark question or an additional part of the essay where it says maybe discuss specialization, and mass production as the effects of international trade. Or you can come across such a question in a form of a high order question where it says, how can international trade affect the economy of a country? Now, when it changes to how can international trade affect the economy of the country? Now, remember, when we come across that kind of a question, it is a high order question. And with high order questions, then we don't have the headings. We just go straight to the discussions. You bring in your examples. You bring in the reality that you know in terms of the international trade. Like I said, it causes interdependence. Then you can give us an example of any country that we are depending on. I just made an example of the crude oil, that because we depend entirely on other countries in supply of crude oil, so the activities in those countries that happen, they affect us. They affect the price of petrol in our own country. So this type of question, like I said, you can expect it as an 8-mark question where you have to just explain 2 of this, or you can expect it as a high order question when now you have to explain either for 8 marks if it's 2.5, or for 10 marks if it is in the additional part of the essay. Now we go to the second part. Our second part is the balance of payments. Now, learners, on this part, I don't know. Because many a times when you look at the balance of payments, you only study the description, the components, the items in the accounts. But when it comes to explaining the items, we have a serious challenge. So we have a serious challenge when it comes to description of concepts. And I'm going to emphasize this until the end of this lesson. Now, when we describe concepts, one other thing that I need you to know is that this description that I've given you is not the only description for the balance of payments. Other books will describe balance of payments in other ways that are not exactly the same as this one. But in economics, we always talk about the components, the elements of a description. So when we think of the balance of payments, first thing is that it's a systematic record. That is the first element that we look at. What are we recording? All the transactions. What kind of transactions? That happen between one country and another country. So it doesn't matter how you put your description, but in your description, we must see that you know that there is a systematic record. And we are not recording anything, we are recording the transactions that happen between our country and the rest of the world. Now, why do we need to record these transactions? We need them. Now we are looking at the purpose or the value of the balance of payments. Now we say we need to record these transactions because for each country to keep a record of all its international trade, if we don't have the balance of payments, then we don't have a record of how much is South Africa actually importing from other countries, how much is it exporting to other countries. Now, we say the balance of payments can sometimes have a surplus. It can also have a deficit. When do we have a surplus in the balance of payments? And when do we have a deficit in the balance of payments? A country is said to have a balance of payments deficit when inflows are greater than outflows. Meaning when there is more money coming into our country than more money going out. When we export more and we import less, then we are going to have a surplus in our balance of payments. On the other hand, A deficit will happen if our inflows are more than our if our outflows are more than the inflows. Now, when the outflows are more than the inflows, it means we have more money flowing out of the country than money coming. We have more money flowing out of the country than money coming in. So a deficit will happen if we are importing more goods and exporting less, because once we import goods, money flows out. And when we export, money flows in. So an ideal situation for in our balance of payments, we always want to have a surplus, because a surplus means we are getting more money from other countries than the money that we are giving to them. Now, the balance of payments has got three accounts. We have the current account, the capital transfers account, and the financial account. Now we are going to zoom in and check these accounts individually. Now, learners, it is important that you learn this account. I'm going to emphasize, you learn this account. You know what a current account is, how to describe a current account, what are the items that you find in the current account, and how to explain each item in the current account. And the same goes with all the two other main accounts. Now let's look at the first one, the current account. The current account is an account in the balance of payments where we record international trade, international transactions. What kind of international transactions are we recording? We record those transactions that relate to production, income, and expenditure. What do we mean? In the current account, we don't record anything that has to do with anything that is out of production, income, and expenditure. Our focus is on money that comes in or money that goes out as a result of production, as a result of income, or as a result of expenditure. So these are the items. We call them this is an account. Account in the balance of payments. And these are the items of the current account. Now we have the first one as merchandise export, which will be a positive. We have net gold exports, which is also a positive. We have service receipts, which is a positive. So all this that are positives, they result into an inflow of money into the country. And these ones that are negative, they represent outflow. Now remember what I said. I said it is ideal for our country to have a surplus in the balance of payments rather than a deficit. What does that mean? It means we must have more of these ones than the outflows. We must have more of merchandise exports, more of the net gold exports, more service receipts, and more income from receipts. Right. Now let's look at these items individually. Now, when we look at the merchandise exports, what are merchandise exports? This is money that we receive. And on this slide, you will see that I have categorized, these are all the items that result into the inflow of money into the country. Now, when we look at merchandise exports, this is income. Remember we said we record the transactions, but we record the monetary value of those transactions. So we say the monetary value of all the goods, the visible and tangible. We're under the merchandise exports, we record only the visible and the tangible. What do we mean? We record those items that we export that we can see and touch. They include raw material, intermediate goods, final goods, etc. And these are sold by us as South Africans. Who do we sell to? We sell to residents of other countries. Hence, we say they are exports. Then we go to the net gold exports. This is income earned from the sale of gold commodity. Now, the question is, why are these gold exports not included in the merchandise exports? Because in the merchandise exports, we said we record the visible and the tangible items. And when we think of gold, gold is one of the visible and the tangible items. But we make it a standalone because gold is our main item that we sell to other countries. Now, why net? If you do accounting, you'll know that when it's net, it means something was subtracted. Now it's net because we subtract the gold imported from gold exported. However, you need to know that the net gold export is always positive. Why is it always positive? Because the net gold that we export is less than the net gold, the gold that we export is always more than the gold that we import. So those are the things that I wanted to highlight and emphasize in terms of the net gold exports. It's a standalone item because it is our main source of income that we receive from the export. So we don't want to include it with all the other exports that we have in the country. Now it's net because from the amount of gold exports, the monetary value of gold exports, we have already subtracted the gold imported from the gold exported. Now, the next item is service receipts. With the service receipts, this is where we record the income earned. This income is earned from services rendered. Now, South Africa provides certain kinds of services. We have financial, professional, insurance, and those kind of. If for example, a resident of Botswana is using an insurance company of our country, that money that we are receiving for the insurance, we make it part of the service receipts as money received from other countries for the services that we rendered to them. We differentiate the service receipts from income receipts in the sense that with the income receipts, we still talk about the income earned. But this is the income earned by South Africans from residents of other countries in the form of salaries and wages, in the form of dividends, interest, and profits. That is how they differ. Actually, you would think if we are saying South Africans receive money from Japan because they work there, and they are providing a service there, why is it not part of the service receipts? It will not be part of the service receipts because service receipts is only about the money received for services. But when we talk about income, we talk specifically about the money received by South Africans in other countries in terms of salaries, wages, dividends, interest, and profits. The next one is merchandise imports now. Now, merchandise imports is about the payment. The first ones were based on money received. Now, these ones are based on expenditure, money paid. Remember, we said when we export merchandise, there is an inflow of money. This money is received for visible and tangible goods. But on the other hand, as South Africans, we also buy the visible and tangible goods from other countries. So when we buy the visible and tangible items from other countries, then we have money that we are paying, and that money that we pay forms part of the merchandise imports in the current account. Payment for services. In the first part, we explained payment for receipts from income earned when foreigners use our services. On the other hand, as South Africans, we also use services from other countries. Now, when we use services from other countries, I'm going to talk about the insurance as one of the services. If you take an insurance with an insurance company that is not is a non-South African company, it means you have imported the service from other countries. So whatever money you are paying for that insurance forms part of our payment for services. The income paid. The income payments. The same goes in as much as we have South Africans that are working in other countries. We also have foreign nationals that are working in our country. So when they work here and we pay them salaries and wages, and then we pay them dividends for shares that they have invested, profits and interest, that money forms part of our income payments. Still on the components of the current account, we have the current transfers. Now, the current transfers is monies, goods, services transferred from South African residents to non-South African residents, or from non-South African residents to South Africa without anything in return. Meaning we receive that money without providing any service. It's a transfer payment. This includes donations, gifts in cash, social benefits, and so on. So the net transfers, we also have net receipts, because when we record them in our current account, we subtract from the gifts that we received, we subtract the gifts that we gave. So because we get more gifts than we give gifts to other countries, then we always have a positive amount in the current transfers. And we don't record them individually. We don't record the donations received and the donations given to other countries. We only record the net amount. Then we have the last part, which is the balance on the current account. Now we say the balance of the current account will comprise of the difference between all the income that we received from other countries and all expenditure that we paid in other countries. So this balance, we said it can either be a surplus or a deficit, depending on whether we received more income or we made more payments. The current account will be in a deficit if the total payments are greater than the total income. This we already spoke about, and we will have a surplus if the total income in the current account is greater than the payments. Then we have a surplus. Now we look at the trade balance. The trade balance, when we calculate the trade balance, we look at the difference between only the tangible exports and the tangible import and the merchandise imports. Tangible exports and tangible imports. In this case, our tangible imports will be the merchandise imports. Now, how do we calculate it? We say merchandise exports plus net gold exports minus merchandise exports. And this one can also be either a positive or a negative, depending on whether we have more income received or we have paid more income. Now let's look at let us look at an activity on current account. Now let us look at okay, just what we just said in the about the current account. Here is an activity. Now the first question, here we have the items. They are not all there, but this is an extract of the accounts that we have in the balance of payments. Now, which account of the balance of payment is depicted in the above table? Remember I said, okay, let's use this one, it's fine. The current account. Now, when we look at this, we say, or the question 1.1, the first question is identify the balance of payments account depicted above. So this is, you can see the account is there. We have the current account. Now let us look at how is the trend of the balance on the current account from 2016. In 2016, we had a deficit of 53 billions. In 2023, 2025. Now, the trend is in 2023, our deficit was 53 billion. 2024, it increased to 68 billion. 2025, it increased further to 165 billion. So what is the trend? It means there is an increasing deficit on the current account balance. Now, describe the term trade balance. Remember, I said in your description of terms, we need to think of the elements of the description. Now, the trade balance is the difference between goods exported and goods imported. Remember, we said we look at only the tangible. So we are not only looking at any exports and any imports. We look specifically on, we focus specifically on the goods exported and the goods imported. We are looking at the tangible inputs, imports, and the tangible exports. Now, the question, another question says, why is gold exports listed as a separate item on the current account? Remember, we said we list the net gold exports as not as part of the merchandise exports, but as a standalone item. This is because we are looking at it because gold has got a historic importance. It is one of our main export product. Because it is it is our main export product. That is why we list it separately on the balance of payments. Right. Now we look at 1.1.5. It says calculate the trade balance and show all your calculations. Now, I'm going to reallocate. Give one mark here. Calculate the trade balance. So the first point of departure is for you to know the items that we use when we calculate the trade balance. Remember, the current account will have many accounts, many items in the current account. But when we calculate the net the trade balance, we focus only on the net gold exports, the merchandise exports. Okay, there's no mark. This one cannot be raised. The net gold exports, then we add merchandise exports, and then we subtract merchandise imports. Now our net gold exports is 70. We are looking at 2025. Forgive my handwriting. So in 2025, our net gold exports was 71,000. Our merchandise exports. Here is our merchandise exports. This is our net gold exports. So it's 7. No, I'm on 2025. Sorry for that. Right. So in 2025, our net gold exports were 71 billion. In 2025, still, our merchandise exports were 743 billion. And then our net gold imports was 854. Anyway, the trade balance was already given here, but we give you a mark for that. So this is how, so when we calculate the trade balance, we look at only these 3 items, the net gold exports, the merchandise exports, and the merchandise imports. So this is the activity that I wanted us to do together in terms of the current account. Now let's go back to the explanations. Then we go to the next account, which is the financial account. With the financial account, it shows the records of investment. It shows the records of transactions. Why? you. With the financial account, we say we look at the records of investments by South Africans in other countries or by foreigners in our country. It shows transactions that relate to liabilities and assets of the country. Now, also in the financial account, we'll have a surplus or a deficit, depending on whether the capital inflows are more than the capital outflows, or in the a deficit in the case where the capital outflows are more than the capital inflows. Now, these are the components of the financial account. Remember, we said in the financial account, we focus on the liabilities and assets of a country. Now we have the first item being the net direct investment. Then we have the portfolio investment, financial derivatives, net other derivatives. Now, in all of this, you will realize that we are always focusing on the net. Why is it so? Because we are always looking at the liabilities and the assets. Liabilities, assets. How much money came in, how much money went out. Now, what I need you to also remember, when we talk about an investment that comes into our country, it's true they bring money into our country, but because that money is not South African money, it represents liabilities. It is an inflow, but it's a liability because that money is for non-South Africans. Now, when we as South Africans invest in other countries, it's an investment. When we buy property in another country, it means our assets are increasing. But because we are buying in that particular country, it represents outflow of money. We don't look at liabilities being liabilities in the way that we know them. But because these investors that come into our country, they bring money in, then it represents the inflows. And all the money that is invested by South Africans in other countries, in as much as they are asset, but they represent outflow of money because money goes out of the country as a result of those transactions. Now let us look at these items individually. When we look at the net direct investments, we talk about investments in real estate, meaning buying of fixed property. So when we buy fixed property in other countries or foreigners buy fixed properties in our country, they form part of our direct investments. Then we look at the portfolio investments. They refer to buying of financial assets such as shares in companies or on the stock exchange of another country. So the difference here is that direct investment are of a investment in the form of fixed property, whereas portfolio investments are in the form of shares. Then we look at the financial derivatives. Now we say these investments are investments in assets which have a future value which is predetermined. In other words, when you make an investment in the form of a financial derivative, you already know what are your returns. It's a contract. You make investment in a form of a contract. You know if you have invested 10 million, you agreed that by the end of this period, I'm going to get 16 million. So it doesn't depend on the economic situation. It doesn't depend on anything. This kind of investment is an investment that is contracted and it has the value, the end value that you are going to receive is predetermined. Then we look at other components of the financial account, which is other investments. Now, these other investments are investments that cannot be classified as direct investments. They cannot be classified as portfolio investment, and neither can they be classified as financial derivatives. These are transactions that are of short-term investment. They are usually short-term. So because they cannot be classified under any of the other three that we spoke about, then we classify them under the direct investment. Now, this direct investment, we say short-term investments that flows in and out of the country, and the trade credits, as well as the short-term loans. So all of these components now form part of our direct investments. Then we have the reserves account. The reserve account records changes in the amount of gold and foreign exchange reserves. Now, those that are held by our country. Now, as a country, we cannot export all the gold that we have. We still keep some in our reserves. And we also have reserves of foreign currencies. We have reserves that are kept, reserves of dollars, pounds, and euros, or any other currency. So all those monies and that gold that we have reserved that we are not selling to other countries, we are keeping it to ourselves. We record them under the reserves assets. And with the reserves assets, we don't record the value of each reserve. We only record only the changes. The changes in gold and the foreign reserves are shown. We don't record transactions as they come. We only record that change in the gold reserves as well as the foreign reserves. I hope I'm not too fast again. I'm looking at time. Tell me if I'm too fast, Ine. Remind me. Right, the capital transfers. Now with the capital transfers, this is an account where we record the transfers of capital, the purchase or sale when people move from one country to another. Now, how do they differ? We are still talking about purchase of items. Now, how is it different from the fixed investment? Now, this one, particularly we look at people relocating, moving from one country to another. But with the other investments, we look at, they can invest while they are still in that country, but they make investments in our country. Now, the capital transfer accounts, they indicate whether the country is importing more or exporting more capital. Transactions and grants relating to the ownership of fixed assets. We're still talking about ownership of fixed assets. That is why I wanted to clarify that. In as much as we are talking about ownership of fixed assets, and we spoke about ownership of fixed assets when we talked about the direct investment, the difference now here is that it's more based on the grants by a foreign NGO for a housing project. Maybe it involves the debt relief, and the balance that is shown reflects the net amount. The net amount of capital transfer, it can either be positive or negative, depending on whether there were more inflows or more outflows. Now, when we calculate in the capital transfer account, we don't have many items. We only have the net lending. The capital transfers comprises of the net lending to or borrowing from the rest of the world. So when we have more net lending, then we have a positive. When we have more borrowing from other countries, then it's a negative. So when we record in the transfer account, we record the amount looking at how much was lended to other countries and how much was borrowed from other countries. Now, remember we said in the balance of payments, we can have either a deficit or a surplus. Now, we said it is desirable for us to have a surplus in the balance of payments, because if it's the disequilibrium means it's either a surplus or a deficit. So it is the responsibility of the country to ensure that the balance of payments disequilibrium is corrected. Now, how do we correct this disequilibrium? We use interest rates, we use changes in demand, we use export promotion, we use import controls, we use borrowing and lending, changes in exchange rates, and import substitution. So these are the measures that are used to correct the balance of payment disequilibrium. Now, this kind of question is a question that you can also expect in a form of a paragraph question, 8 marks, or in a form of a paragraph question, high order. Now, in the form of a paragraph question, 8 marks, middle order, you'll be expected to explain 2 of these items. But if the question says, how can the balance of payment disequilibrium be corrected, then it means you have to include almost all of them, and you are expecting to answer this in a paragraph form, high order, for 10 marks or 8 marks. Right. Now let us look at the first measure that can be used to correct the balance of payment disequilibrium. We use borrowing and lending. Who borrows where? Now we say a country experiencing a deficit. When there is a deficit in the balance of payments, that country can borrow money from other organizations such as the International Monetary Fund or foreign countries, the governments in other countries. Now, a country with a balance of payment surplus, I get the first one has a deficit, and then they borrow from the IMF or from other countries. Now, on the other hand, if a country has a surplus, they lend money to other countries, reducing the excess foreign currency inflow. Now, how does this help to correct the disequilibrium? It's because if there is a deficit, you are able to correct your deficit by borrowing money from other countries. If you have a surplus, you have more, then you have more money that you can lend to other countries and receive interest. Now, when you look at the two, countries that usually have a deficit in the balance of payment are the developing countries. Those countries that have that are still developing, the poor countries, if I may put it like that. So the poor countries usually have a deficit in their balance of payments. That is why they always have so much foreign debt. They are always borrowing money from other countries. In the event of a fundamental disequilibrium, a member of the IMF can borrow money from the International Monetary Fund. Now, looking at the changes in exchange rates, we are going to look more on the appreciation and devaluation of the currency, as well as we are going to look at the depreciation and appreciation of the currency, as well as devaluation and revaluation of the currency later on in our lesson. But now when we talk about the changes in the exchange rates, we say The currency depreciation or devaluation makes imports more expensive for domestic consumers and exports cheaper for foreign buyers. For example, when the rand depreciates, South African exports become cheaper. Now, when they become cheaper, what happens? There's going to be more demand for our South African products. When there's more demand, it means more inflows. On the other hand, if the currency appreciates, then our exports become more expensive. And when they are more expensive, it means we are going to export lesser. Then we look at export promotion. The government incentives that are applied to encourage production of goods that can be exported. Remember, we are looking to have more exports so that we have more money coming in and we are able to correct the deficit in our balance of payments. So which means if the government give incentives to producers so that they can produce goods that can be exported, it means our exports are going to increase. More exports means more foreign currency entering. This is going to help the balance of payment deficit. The more we export, the more inflow of money. And remember, the more inflows, if our inflows are more than our outflows, then we are able to correct a deficit because we will be experiencing a surplus in the balance of payments. When we have more exports, it means we have more money coming in. And when more money is coming in, we are going to have lesser deficit, or we will even have a surplus in our balance of payments. Another strategy is the import substitution. Now, this one encourages local production of goods rather than importing. Meaning, with import substitution, we encourage our local citizens not to buy goods from other countries, but we replace those imported goods with the locally produced goods. So when we do that, it means that our imports are going to decrease because people will be buying goods from our own country. Now, by replacing imports with locally produced goods, what is going to happen? We reduce the outflow of money and we improve our balance of payment. Our balance of payment position improves, meaning that when our inflows are reduced, we are going to have maybe a surplus in the balance of payments, but the deficit will also decrease because more money, lesser money is flowing out of the country. We substitute imports to protect our own local producers and to discourage to ensure that we replace the goods that were previously imported with the locally produced goods. Now, how does the government do that? It gives incentives to produce goods domestically. It gives our local producers some incentives, some subsidies and benefits in kind that will make them to produce goods domestically instead of us importing them from other countries. And then we look at the interest rates. Now we say, if the interest rates are increased, if our interest rates are increased, it includes, if interest rates are increased, spending decreases. Why is it like that? If interest rates increases, access to credit becomes lesser. So when people are not able to access more money in the form of loans and credit card, it means their spending is going to decrease. And this spending will not only decrease for goods that are bought locally, but it will also decrease in terms of goods that are imported. On the other hand, foreign traders will try to take advantage of increasing interest rates, and they will increase their investments because they are going to get higher returns due to higher interest rates. So in the first part, we are looking at the consumers, and we say if the interest rates are high, people are not going to, if the interest rates are increased, people are not going to spend more. And when this expenditure that we are talking about involves expenditure on goods domestically and expenditure on goods internationally. So consumption of goods that are imported will decrease. Now, on the other hand, it's good because we are going to get more investments. High interest rates attract investors into our country because they are looking at higher interest rates. They are going to get better returns for their investment. Now, this brings more foreign currency into the country. More foreign currency is coming into the country, and that helps us reduce the balance of payment deficit. The opposite happens when interest rates decrease. Now, what do we mean? When interest rates decreases, there's going to be more spending, meaning if there's more spending, there are going to be more imports. On the other hand, when we say the opposite also happens, it means if our interest rates are low, we are not going to attract a lot of investors because the investors will want to have more returns for their money. So when the interest rates are lesser, they are not encouraged to invest. The other measure that we use is import controls. These are measures that we use in order to limit the imports. Remember, everything that we are talking about here, we want to correct the balance of payments disequilibrium. So what will happen if we limit imports? It means we are going to have less money going out to pay for imports, which is good for our balance of payments. Now, the government may also use tariffs and quotas to restrict imports. Trump has just increased the tariffs for us exporting to them. Then it means that way he's limiting the amount of goods that will be imported into his country. He's looking at having lesser goods that flows into the country. So that is why we say the governments use tariffs in order to restrict imports. The more tariffs there are, it means the imports now become more expensive. And if the imports are expensive, people will be discouraged from buying from other countries. And why does reduced imports benefit us? Because of the imports decreasing, we are able to correct the deficit in the balance of payments. Because if we reduce our imports, it means we are not buying from other countries and there's less money flowing from our country to that other country. Okay. Now we look at the types of exchange rates. There we have our diagram. Let's go straight to the explanations. We have free floating exchange rates. Okay, let's go back and see here. A glimpse explanation of these three exchange rates. Now, when we look at the free floating, the buzzword is that we use the market forces to determine the value of the currency. Now, market forces, we talk about demand and supply, meaning here, there's no government intervention. And when we use the free floating exchange rate, our currency, we say it will depreciate or it will appreciate. Now, when we look at the fixed exchange rate, now this one does not allow demand and supply. It only allows government intervention. It's a deliberate action by who? By the monetary authorities. When we talk about the monetary authorities, we are talking about the government. So under the fixed exchange rate, there is no interaction of demand and supply. Whether the currency is increasing or decreasing, it's a deliberate action. It's a decision that is taken by the government to either devaluate the currency or revaluate. So you need to remember this when we go and explain this further, that under the free floating, the buzzword is the demand and supply as market forces, and we use the currency depreciates or it appreciates. Now, when we look at the fixed exchange rate, now this one, there is no demand and supply that determine the value of the currency. The government decides when to devalue the currency or when to revalue the currency. And then we have the managed floating. This one it encompasses both. Now, in our country, South Africa is using the free floating exchange rate. Now, in a country where they use managed floating, it means they allow demand and supply to determine the currency, but at some point, there's a combination of what happens in the free floating and what happens in the fixed exchange rate. So with the managed floating, there is some freedom as a result of market forces, but also there is government intervention where the government will also decide, no, we want to revalue this currency or we want to devalue it. So these are the three exchange rate systems that we are going to look at. Now let's look at the explanations. Free floating exchange rate is an exchange rate in which the value of the currency is determined by demand and supply. It's determined by the market forces strictly. No intervention by the government, no intervention from anywhere else. If the value of the currency is going to improve or deteriorate, that is entirely dependent on demand and supply. Now, we have two situations when it comes to free floating exchange rate. The value of the currency may either appreciate or depreciate. Appreciation means the currency becomes stronger as compared to other currencies. So if our currency is becoming stronger, and this strength is determined by more demand for the currency, then the currency has appreciated. Now, we say you can only buy more foreign currency with the same amount of currency if there's an appreciation. When our currency appreciates, it means we can buy more goods from other countries with the same money that we used to buy before. Now, in terms of the depreciation, okay, we say if the price of $1 changes from 15 rand to 10 rand, what does that mean? It means our rand has appreciated. Now, the question would be, why do we say it has appreciated when we say it changed from 15 rands to 10 rands? Now, the answer is, when the dollar was 15 rand, it means we used to use 15 rands to buy $1. Now, if we can now use 10 rands to buy the same dollar, it means now we are spending less but receiving the same goods that we used to get. And when this happens, it means we are able to import lesser from other countries. But when that happens also, it means for them, it becomes expensive for them to buy from us. The goods that when our currency appreciates, it means they are now spending more when they export goods from us. But with us, it's good because we are now spending less when we import goods from them. However, the appreciation of the currency can also be not so good for our exporting businesses because remember, we said in order to correct the balance of payment, we need to have more exports. So now when the currency appreciates, our goods become expensive. So when they become expensive, it means other countries will no longer be able to buy as much as they did before. Depreciation of the currency becomes weaker. And, the depreciation means the currency becomes weaker in the free floating exchange rate. Now, an example here. If a dollar was 12 rand and now a dollar becomes 18 rand, it means that dollar where we used to buy it with 12 rand, we are now buying it with 18 rand. What does that mean? It means the dollar is now expensive. And if the dollar is expensive for us, it means the dollar has appreciated, but our currency has depreciated because the dollar is now worth 18 rand, whereas in the past it was worth 12 rand 60. I hope this one is clear. You will indicate if you need clarity. And then we look at the fixed exchange rate. With the fixed exchange rate, we say the rate in which the currency is determined by monetary authorities. It's a deliberate action. It's intentional. Now, the government intends to either reduce or increase the value of the currency. Now, with the fixed exchange rate, we use devaluation and revaluation. Now, when we describe the fixed exchange rate, it is important to know that the value is determined by monetary authorities. They do it intentionally to improve the value of the currency, which we call revaluation, or to reduce the value of the currency, which we call devaluation. Now, devaluation is when the government purposefully, intentionally, deliberately lowers the value of their currency. It makes their exports cheaper and imports more expensive. When they want to make their exports cheaper so that they export more, they decide to devalue the currency. When they want to limit the number of goods that are imported, they make imports to be expensive by devaluing their currency. This is a deliberate action by the government. Now, with revaluation is the opposite. What happens is that the government raises the value of the currency. Now, when they revalue the value of the currency, they want to make exports cheaper and imports now become expensive. Right. So the last one is the managed floating exchange rate. The managed floating exchange rate is an exchange rate in which the currency, there is a combination of market forces and intervention by monetary authorities. So now in this type of exchange rate, we have all the way we have depreciation, appreciation, revaluing and devaluing of the currency, because we have combined the market forces which relate to appreciation and depreciation of the currency. But at the same time, there's government intervention that will decide either to devalue the currency or revalue it. So these are our exchange rates. Okay. In just a few minutes, let us look at the exchange rate equilibrium. With the exchange rate equilibrium, we have here the price of the dollar. Let's name this let's say this is 10 rands. Now, when you look at this graph, we have our equilibrium where a dollar is equal to 10 rands and $100 are bought and sold. But if it happens that the dollar becomes now it now becomes 12 rands. Now let us look at this. We say our equilibrium is at this point. At the price where a dollar is equal to 10 rands, $100 are supplied and $100 are demanded. Now, what will happen? Once we have the price of a dollar changing from 10 rands to 12 rands, it means our rand has depreciated. When it changes from here to there, our rent has depreciated. And when that happens, we experience excess supply. When our rent is moving from 10 rands to 8 rands, it has appreciated. And when it has appreciated, there is excess demand. So how do we explain it? We say at the equilibrium point of E here, this is where demand equals supply of dollars at that point. The price at equilibrium is labeled 10, that is where we have 10 rands and 100 quantity demanded and supplied. Now, this is where we have our equilibrium. Now, when the price increases from 10 rands to 12 rands, the price of dollar becomes too high, because we said when the price is 10 rand and it changes to 12 rand, the value of our currency has depreciated, meaning that the dollar is now becoming more expensive for us. Americans and other foreign countries will bring their dollars into South Africa because they get more rands per dollar. Ne? When our rand depreciates, then the Americans are able to get more rands with the same dollar. Now what happens? Rona as South Africans, we don't want to buy more dollars because the dollars are expensive. So the excess supply of dollars is experienced at this point where the rand has depreciated to 12 rand per dollar. Now, when I want to explain this, when a rand changes from 10 rand per dollar to 12 rand, it means the rand has depreciated because $1 is no longer 12 rand, but it is now 12 rands. On the other hand, when this happens, it means the value of the dollar has improved, but the value of our currency has depreciated. But when it changes from 10 rands to 8 rands, it means the rand is now becoming stronger because instead of using 10 rands to buy $1, we are now only using 8 rands to buy that dollar. So in this case, our rand is appreciating and the dollar has depreciated. Okay, I'm looking at time. I'll just finish now. Now, what happened? This one, we are going to look at the change in the demand for dollars. Here we have this side, we have quantity demanded or supplied. Now, we have here our supply curve and our demand curve. Now, our original equilibrium is formed at 10 rands. When the value of dollars is 10 rands, 100, our quantity demanded was 100. Now, what happens? When the demand increases, now it shifts to the right. This is our first equilibrium. So when demand shifts to the right, we have D1, dy. And we have our new equilibrium at this point. Now, what happens? At E1, the value of our dollar is now 12 rands. So after the demand shifts to the right, the equilibrium point shifts from E to E1. And the price of dollars shifts from 10 rands to 12 rands. The quantity shifts from 100 to 150. Now we see that as the price of the dollar becomes 12 rands, there is more demand for our rands. That is what we said. It becomes cheaper for them to buy our currency. Now, this is what it means. When the value of the rand decreases from 10 rands to 12 rands per dollar, we see an increase in the demand for the currency, and that makes our demand curve to shift to the right. This shows that an increased demand for dollars pushes the rand of the rand dollar upwards. So in this case, there is more demand for dollars. And when there is more demand for dollars, our currency now depreciates. Now, in essence, what does it mean? When many of our tourists are visiting in another countries, it means the value of our currency is depreciating because they are taking our money and there's more demand for services that are rendered by other countries. Now let us look at the terms of trade. Okay. The description of the terms of trade shows the ratio between the prices of a country, the prices that the country receives for its exports and the prices of the country for its imports in terms of indexes. It tells us whether the country can buy more or less from the world. Whether we are able to buy more or less is determined by the price of our imports, in the index of price of our imports as compared to the index of our export prices. So we calculate the terms of trade and we say terms of trade is equals to the index of export prices divided by the index of import prices multiplied by 100. So like I said, the terms of trade tells us whether we are able to buy more or less from other countries. Now, how do we use these terms of trade? How does the terms of trade affect the economy? The terms of trade can either also be positive, they have improved, or they are deteriorating. So when they deteriorate, it means the export prices are rising more than the import prices. If the export prices are rising more than the import prices, it means that the country can afford more imports with the same amount of money received from their exports. The country can buy more imports for the same amount of exports, meaning that with the same amount that we are exporting, we are able to pay for our imports with that same amount. The export earnings rise as compared to the import costs, and the country becomes better off in terms of their standard of living. Now, okay, 5 minutes, I'm almost there. Effect of the negative effects of when the terms of trade decreases. When the terms of trade decreases, import prices are rising faster than export prices. And what does that mean? It means our country sells more exports just to remain in the same level of imports. Now, if this happens, it means we are now reliant on importing expensive manufactured goods while exporting cheaper raw materials. And this happens mainly in the developing countries where most of their exports are in the form of raw materials, because they are not able to transform them into finished goods. Now they rely on manufactured products from other countries. The bad thing is that this reduces the national wealth and international purchasing power, and the country becomes worse off and the standard of living may decrease. That is that in terms of the terms of trade. And I think we have come to the end of our lesson. Thank you. I will wait for the questions in the remaining minutes. Thank you so much, learners. I'm opening up for you to ask questions. Learners, do you have any questions? All right then, learners, if there are no questions, then this is the end of our lessons, our lesson for today. I wish you all the best in preparation for the June exam. Go and do your best, and more studying, more practice is what will make you successful in this coming June exam. Thank you, learners, and thank you, colleagues who have joined. Thank you so much. Enjoy your afternoon.